Good morning. It's Monday, March 23rd. Here's what's on the agenda. Stocks and bonds drop as the US and Iran harden their rhetoric. Oil prices climb with President Trump's Hormuz deadline approaching. And gold sinks on deepening inflation concerns.
All of that weighing on equity market futures then this morning. Lizzy, the European futures picture looks pretty negative this Monday morning, down by 1.9% on Euro Stoxx 50 futures. Some of the underlying markets there already in correction territory as we see threat and counter-threat traded by the US and the Iranians. The markets see no off-ramp. They see just escalation, and that weighs on sentiment. S&P futures also down by 0.9%. NASDAQ futures now down by 1%. Brent crude up only 1%, you might say, given the context and the rhetoric we've seen over the weekend. But of course, it's up 50% since February, and further out the curve, you see quite a lot more response on the Brent price this morning. The countdown to the opening trade starts right now.
We're now in the fourth week of the Middle East war. Traders dealing with fatigue, volatility and confusing signals, frankly, out of the White House. President Trump said that he was thinking about winding down military operations against Tehran, and then he gave a 48-hour deadline to Iran until just before midnight in London tonight, in fact, to reopen the Strait of Hormuz or have its plants bombed. So, Anna, the stock sell-off continues. You've seen Asian shares down for a third day, set to enter a correction. Futures down on both sides of the Atlantic. Global bond yields at their highest level in years in anticipation of rate hikes, and the dollar up on President Trump's latest threats.
Yeah, the narrative has shifted a bit over the weekend, to your point, Lizzy. Saturday, we got a slightly more conciliatory tone from President Trump, talking about, dialing things back. And then today, things don't look that way. President Trump saying to the Iranians, you've got a 2-day deadline. That was on Saturday. As you say, late Monday is when that expires. Open the strait or we bomb your power plants, essentially. The Iranians say if you bomb our power plants, then we take aim at energy technology and desalination infrastructure within the region that's backed by the US and Israel. So the rhetoric continues, escalation continues, stocks drop. We are looking at futures that are pretty negative for Europe, but also for the United States. And I think that's interesting. But that really does follow on from Friday, where we saw considerable negativity around risk assets and a real rise in bond yields. Some of the moves higher in the yields. 10-year Italian BTPs, the yield up 18 basis points, gilts up 14 basis points. And it wasn't just, that's the 10-year, the 2-year showing some elevation as well on the yields, but it wasn't just the short end. It was the whole of the curve in focus for European bond markets and to some degree going global.
Yeah, the question being how much does this become not just an inflation crisis, but also a growth crisis the more that this progresses? Look, when it comes to what happens next in the Middle East, some analysts saying that Trump's in a corner here because it's highly unlikely that Iran is going to agree to his terms on such an accelerated timeline under the threat of attack. So we just have to watch towards that almost midnight deadline tonight for what happens next.
Yeah, absolutely. A lot of the analysts looking at the incentives that Iran faces right now and asking, do they really have any incentive to open the Strait of Hormuz, and certainly suggesting that they won't. And that takes us on to commodities. Commodities, of course, the epicenter of the supply chain disruption and energy crisis that we're now seeing here. And as I mentioned a moment ago, Brent prices are higher, up by 1% on Brent. WTI has perhaps notably, given the president's focus on higher energy prices, gone above $100 a barrel. So we keep that in mind. And we are seeing actually WTI responding more than Brent at the short end of the oil curves. Further out the curve, you see more response in Brent, though, as if the market has taken the weekend to think about, yes, we knew about the short-term risk to supply, but now we're prepared to think about the duration of these disruptions and what that means for energy prices further out. So that is something of a focus.
Yeah, Goldman's raised its 2026 Brent forecast to $85 a barrel from $77. But some analysts are saying it's not going to drop back to where it was even if the Strait of Hormuz reopens, because a security premium will have to be baked in. Some analysts saying to go higher from here, it's going to take something tangible. We've talked a lot about the rhetoric on both sides hotting up, but analysts saying it's going to take more than an escalation of rhetoric for the price to climb again. It'll be broader issues with shipping or insurance. But of course, all of this is the backdrop to Sarah Week that's happening in Houston. The war obviously going to dominate discussions in the oil industry, but we report that the Aramco CEO isn't going to be there because he's having to deal, obviously, with the situation in the Middle East.
Yeah, something more pressing at home to deal with. And we've heard from the IEA, the Energy Authority, the Energy Agency, of course, and they have their assessments of what kind of damage we've seen to energy infrastructure in the Middle East. And this is really important to that futures curve, to the duration of the disruption that analysts are expecting. He's talking about, this is Fatih Birol, talking about more than 40 assets at risk of severe or very severe damage in the region. He then gives the context around how big is this versus 2022 versus energy shocks in the 1970s. He says we're facing the largest energy shock we've ever faced. He says this is 2 times bigger than what we saw in the 1970s and the 2022 energy shock, all of that combined. So certainly upping the ante when it comes to the scale of what we're witnessing here.
So we've seen higher oil prices, but we've also seen the price of US gasoline, fertiliser and many metals climbing because of the continued effective closure of the Strait of Hormuz. But also, on the flip side, gold down. So nearly 3% down, close to wiping out its gains for the year, which is strange, isn't it, when we take a step back and consider that we are in the middle of a war, we're facing potential stagflation, but it appears that traders have been selling to cover their losses elsewhere in their portfolios. And there's a great column by Edward Harrison in his Macro View saying that this is potentially a harbinger of more generalised profit-taking, but the question being whether gold comes back when this sell the winners phenomenon is done. Yeah,
it's interesting. Bond markets, we've seen them very much reflecting inflation concerns, and that seems to be doing damage to gold. If the bond market story flipped and we started worrying about growth concerns, would we see something different in metals markets as well? Because we have those that sort of inflation everywhere concern, higher for longer rates, and all of that. If you're going to get higher rates on all kinds of assets around the world, then maybe you don't need gold so much, or gold which doesn't pay you that coupon, maybe that doesn't look quite so appealing. The opportunity of cost of holding it doesn't look so good. You add to that the fact that it had done just so well, that and silver running into this, and of course it is very liquid, and we have another day of quite substantial losses on gold and on silver, both down 7.5%, 8.5% right now. So ongoing focus on what's going on with metals.
Yeah, interesting that silver and the Kospi have moved in lockstep as favoured trades for retail investors. Silver's drawdown approaching 30%, and today you're looking at the Kospi just going right back to where we started with equities. The Kospi down 6.5% right now.
Yeah, absolutely. So the Kospi and Japanese markets, the epicentre of the selling, the MSCI Asia Pacific down by 3.7% at this point. Let us tell you what is coming up on the programme. We have assembled a great roster of guests to talk to about all of these market dynamics. Pooja Kumra joins us, TD Securities Senior European and UK Rates Strategist. Incredible moves really on Friday. How much will we see that continue today, or will there be a line in the sand? Maria Minucci, M&G Investment Multi-Asset Fund Manager. Where on earth do you try and position your portfolio? How do you find any safety right now? Mark Giannoni will be with us, Barclays Chief US Economist in town. So really good to get his perspective as to what damage to expect for the US economy and what the Fed does with potentially new leadership on the horizon.
Let's take a look at what else we're watching throughout the week. Today we have Ursula von der Leyen visiting Australia. We also have Sarah Week kicking off, as we mentioned. Then tomorrow, lots of global PMIs dropping, plus Denmark's snap general election. Then on Wednesday, we get UK CPI, the expectation being that slowdown in inflation will stop at 3% in February. On Thursday, we have the G7 foreign ministers meeting, as well as the OECD interim economic outlook. And then on Friday, the University of Michigan Consumer Sentiment Survey, as well as Spanish CPI. But these PMIs really in focus this week. The global economy's first health check really since the war broke out. An interesting afterthought to the central bank decisions last week, and a bit more of a read on how economies are faring when a lot of those projections that central banks put out were already out of date on publication.
Yeah, absolutely. And you wonder how much of the forward-looking stuff is reflected in these PMIs. How much are purchasing managers nervous about the future, thinking about their supply chains? You would think to quite a high degree, wouldn't you? But actually looking at the estimates, the things that we're expecting from PMIs, yes, we're expecting a bit of a retreat across the Eurozone, France, Germany and the UK data also. But we're not really expecting a dramatic drop back in this PMI data, which I think in itself is quite interesting. I mean, the ZEW, sure, that's investor expectations. It's not business leaders. But that really tanked. And so if that in any sense filters through into this PMI data, then maybe we're up for something a bit more negative.
Yeah, that could add to the volatility. You've also got CPI, as I say, in the UK. That'll get a lot of attention after the gilt yield moves that you mentioned last week. But speaking of the UK, important today, we have the Prime Minister meeting senior ministers as well as the Bank of England Governor Andrew Bailey to talk about the Iran crisis and what happens next. They'll talk about energy security, they'll talk about supply chain resilience, and also the international response to the war, because of course so much pressure from the White House on Keir Starmer to get more actively involved.
And it seems like a lot of the European narratives have turned to, well, what can these European governments do to help their populations cope with higher energy costs? The extent to which they're able to move on that subject is interesting versus 2022, where we saw quite a lot of support rolled out for households and bond markets. The extent to which they will tolerate any higher spending and higher indebtedness is certainly something we will keep watching. 10 minutes past 7 here in London, Monday, 23rd of March. Let's get up to date on some of the other stories that we're following for you this morning. LaGuardia Airport has been closed to incoming flights on Sunday after an Air Canada Express flight collided with a vehicle shortly after landing. Police say the aircraft hit a Port Authority of New York and New Jersey ground vehicle. Images circulating on social media appear to show an Air Canada plane tilted on its tail with the nose of the aircraft ripped off. NBC News is reporting that both the pilot and co-pilot died in the collision. German Conservatives, led by Chancellor Friedrich Merz, have dislodged the Social Democrats from power in a southwestern state after 35 years. The win comes as Merz struggles to gain nationwide traction among voters. Meanwhile, over in France, Marine Le Pen's national rally fell short in its bid to take control of a host of major French cities in Sunday's municipal election. In Paris, the socialist Emmanuel Grégoire is on course to win the race for mayor, extending the left's quarter-century hold on the French capital. And Poste Italiane says it will launch a voluntary public offer for Telecom Italia, valued at about 10.8 billion euros. The cash and share issue would see Poste Italiane take full control of the former phone monopoly, setting up its delisting. The offer is at a 9% premium to Telecom Italia's closing price on Friday.
Coming up on the programme, UBS CEO Sergio Emotti says energy prices are likely to stay elevated as investors digest the impact of the Iran war. We'll bring you some of that exclusive interview later on in the show. Plus, the IEA reveals more than 40 energy sites have been damaged in the war. We'll discuss the implications for the sector. But up next, we'll be joined by Kit Dukes, Chief FX Strategist at Societe Generale. If you've got any questions of your own for our guests, please do send them in to us on IB plus BBTV Go. Good morning from London. This is Bloomberg.
Welcome back, everybody. 45 minutes and then until the start of cash equities trading here in Europe. And we are seeing the effects of the threats we've seen from the US and Iran, each of them threatening each other over the weekend. And as a result, equity market futures are once again negative. The US and Iran trading threats then as the conflict enters its fourth week, showing no signs of de-escalating. US President Donald Trump issued Iran a 2-day deadline. That was on Saturday to reopen the Strait of Hormuz or face its power plants being bombed. That expires Monday evening European time. Iran countered that it would close the strait completely if its power facilities are attacked. Treasury Secretary Scott Bessent told NBC's Meet the Press that Hormuz is in its sights, with the US aiming to destroy Iran's fortifications along the strait.
Every day, we are taking out their missiles, their missile systems, and the factories that build those missiles. And now the General Kane, Secretary Hegseth are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Again, they're not mutually exclusive. Sometimes you have to escalate to de-escalate, Chris.
Let's get analysis from the region. Bloomberg's Jemana Besechi joins us from Dubai. Jemana, good morning. So what is the latest then as we approach President Trump's deadline later today?
Well, Treasury Secretary Scott Bessent there framing it as sometimes you have to escalate to de-escalate, and that is exactly the situation that we may be in the coming 24 hours. I'm referring to the post that President Trump put up over the weekend, specifically at 7:44 p.m. on Saturday. And the reason I cite that time is because he's basically given Iran a 48-hour ultimatum to reopen the straits without threat, or else, he says, the U.S. will hit and obliterate various power plants, starting with the biggest one first. And Iran has around 100 power plants that they're sitting on that could potentially be targets. Now, Iran were quick to retaliate as ever, and they said that if that does happen, and if civilian infrastructure is targeted, then they, in turn, will strike back on all energy, information technology, and desalination infrastructure linked to the U.S. and Israel in the region. And so what we're sitting on here now is sort of wait and see to see whether the U.S. administration, whether Trump actually acts on that ultimatum. We expect that to occur at some point in the middle of the night, the 48-hour window. But overnight as well, Iran went one step further. The Speaker of the Parliament also put out a post suggesting that any U.S. financial institution that also has bought U.S. treasuries may also be deemed a risk as well. So lots of this very harsh rhetoric coming through from Iran about a potential escalation even further and potentially more structural and targeted strikes on key infrastructure around the region. And so as we enter into day 24 of this war, Anna, really no signs at all that things are de-escalating. In fact, quite the opposite. And just to add to that, there were also reports emerging on Friday that the U.S. administration is weighing up sending around 2,000 to 3,000 Marines to the Persian Gulf alongside the potential takeover of Karg Island as well. And if that does happen, that's all going to play out over the series of weeks, not necessarily days, which also implies that what we're settling in for now is another few weeks of this at the very least, as opposed to a conflict that could be resolved in the coming days, or as President Trump suggested on Friday, that they would be looking to wind down soon.
Okay. Jumana Basechi out of Dubai, thank you very much for the update. Well, let's play out how all of this is going to happen in the markets, particularly in currencies. We're joined now by Kit Dukes, Chief FX Strategist over at Societe Generale. Kit, welcome back. So you heard Jumana there. We've got the dollar up again this morning. I wonder how much further it has to run if this war continues for another few weeks, and with Fed hikes, I should say, looking more likely.
Well, I think it can run quite a long way in a sense. I mean, I can't imagine wanting to own this morning a currency of a country that wasn't an oil producer, to put it really, really simply. In other words, you take the example of Australia, just about the most fashionable currency so far this year. The market's still long of it last week. They have about, I think, 30 days worth of oil reserves. So you turn around and you say, well, if we do this for another 30 days, for example, they have a big problem, in the sense of they have, LNG, but I have pictures in my mind of people in the outback and trucks driving around, and, it's not going to work very well. You cannot cycle around Australia much. So I think that's a real threat for even the most attractive currencies if this goes on. So the dollar's fine, the Norwegian kroner's fine, the Canadian dollar's fine. The rest of us, we have a completely different set of problems if this lasts for 2 months relative to 1 month.
And this might sound far-fetched given what Jumana was just saying, but let's say at the end of this 48-hour deadline from President Trump that Iran were to reopen the Strait of Hormuz. Would the dollar reverse the gains that we've seen, or would it just be a pause?
You'd pause for a bit, because this is too fluid a situation to be able to turn around and say, yeah, everything's good now. It's kind of in a bit the same. We're not going to get oil prices to suddenly fall back a really long way. But there is a material, for me, there's the difference not so much with the oil price and what it does as the availability, because we're taking a big hunk of global supply of oil out, and without that, someone's not going to have any. I mean, that's the sort of end game. If it's more expensive for longer, if we settle at $90 a barrel for a significant length of time, the dollar doesn't go up, that much on the back of that. That's a different story. So it's very fluid in the sense that this will end one day, and the outlook will change immediately. As of this morning, I don't care almost what the Fed does. They are a big oil producer, and that makes all the world of difference.
OK, and that is what, as you say, what the market seems to be focused on in terms of FX, tangential to FX, but I wonder your views on it, Kit. We see big moves in metals prices and precious metals in particular. So silver down by 9.6% right now, gold down by 8.7%. That's just in today's session. So once again, we're seeing the markets selling the things that have done well, selling the things that are really liquid, and perhaps spooked by inflation once again, and that's the result. What do you think drives this, and how much further does this trend have to run?
It can go further. I mean, I think Mike Haig, my commodities colleague, will be on later, who is much wiser. But I do have a sense that some people have been using gold in particular to sell their gold's gone up a lot in order to buy more expensive oil and things like that in the short run to kind of get hold of supply. So, some of this is just practical. It's gone up a lot, and that's gone up a lot, and I can just shuffle some because I need this now. I don't think the long-term story for precious metals is going to change that much. I don't think that people will go on writing articles about the dollar's position in portfolios and a fragmented world and uncertainty.
That's why I ask you, really, because before we got into this Iran war, Kit, the story was around, well, the question being asked at least was to what extent were we going to see de-dollarization, and were gold and silver going to be the beneficiaries of that?
And even on Friday, people were asking, should I be selling the dollar now because they're creating so much uncertainty that I don't want to buy treasuries? I think there's an argument that the rest of the world has invested so much money in the United States, and this presidency has caused so much uncertainty that some people would like one day to have less of their money invested in US assets. But that feels like, yes, that's a nice theoretical position, not today's issue.
And in the moment, you just refer them to the fact they produce oil and energy, and that's where we started the conversation.
Can I come back to central banks, but more so in Europe? Because we had quite hawkish language from the Bank of England, perhaps compared to the ECB, and yet you saw the pound weakening against the euro by the end of the week. Do you think that's a reflection of traders perhaps not really believing that the Bank of England can hike rates when the growth backdrop is weak?
Yeah, I think to some extent the growth backdrop's more important than the rate backdrop. I don't just buy UK assets because we have higher rates. I mean, clearly they help, but it feels as if you're seeing forecasts for the UK economy come down to 0.3%, 0.4% from some people already now. It feels as if this goes on for a long time, we're going to have a very ugly position that's going to turn into an ugly fiscal position, and that's going to turn into a problem that then I don't care what interest rates are if we're going to start really worrying about the long end of the gilt market again and things like that. So I'm not surprised that it didn't react so positively to that. Again, it looks as if the Bank of England is closer to raising rates than some. I can't believe that would help the economy right now, and it's not that great already.
Mm-hmm. Yeah, I mean, we do seem to be worrying a lot about inflation right now for obvious reasons, Kit, and as if we can't maybe worry about inflation and growth at the same time. Should we be doing more of the latter?
I mean, the UK has a difficult growth inflation trade-off at the moment. And Hugh Pill mentions it, I think, in almost every single set of minutes, that he's uncomfortable that the neutral rate and things are going up. And so he's sort of been banging on about it quietly in his corner for 12 months. And if you kind of take that, you say, well, yeah, it's not a great picture for a currency if you're telling me my growth inflation trade-off's bad and my neutral interest rates sort of higher. You're not making me invest masses of my excess money in the UK until I get to the point where I say, look, nothing else really matters. You're offering me yields on gilts that I know they're not going to default. Let's not be silly. My pension's going into it.
Kit, thank you very much. Thanks for bringing us your thoughts this morning. Kit Jeeks, Chief FX Strategist at Societe Generale. Lots more to talk about when it comes to bond markets. Coming up, global bond yields climb due to angst around the Iran conflict and its impact on central bank rate paths. We're actually seeing European bond markets just opening up this morning, and we are going a little bit higher. Certainly in France, I can see that the yield is a little higher. In Germany as well, and in Spain, those markets now open. Of course, the UK market not yet open. We'll see what that does in around 35 minutes time when we get the gilt open. We will talk to Pooja Kumra about all of that, senior European and UK rate strategist at TD Securities. That conversation coming up next here on The Opening Trade. This is Bloomberg. Welcome back. This is the opening trade. 30 minutes this Monday morning until the start of cash equities trading, and we are going to feel the effects of the rhetoric from the US to Iran and back again. That is going to weigh on equity markets at the start of the European trading day. Some of this goes back to Friday's session in the States because we had US equities down considerably on Friday, Lizzy, toward the end of the session, and we need to catch up with that. But US futures also pointing lower, incidentally, down by 1% on E-minis and on Nasdaq futures. But Europe, for the moment, will be in the crosshairs.
Yeah, yields higher stateside on treasuries across the curve. But if we look at the European bond space, we also have yields higher across the continent, across the curve. Investors, of course, increasingly concerned about inflation as a product of the war. That upending rate expectations. But do note here, you've got the French 10-year yield higher 5 basis points. We've just had those local elections in France, the far right missing the key targets in those municipal elections. And we'll get more on why this reaction has been the product of that in just a moment.
Yeah, in fact, let's go to that, shall we? Joining us now, Pooja Kumar, Senior European and UK Rate Strategist at TD Securities, with us this morning. Pooja, good morning. So Lizzy's just been through some of the movements we've seen in bond markets this morning. During Friday's session, we seem to see almost across the board higher yields, not quite everywhere, but a lot of higher yields across Europe and a lot of different parts of the curve as well, not just the sort of short end. Today, we see some more of that, but in particular France and Italy, where we see yield spreads, I should say, widening. What's happening? Let's stick with the France story for a moment, because, of course, we've got this political dimension. Is it the politics that pushes that yield higher this morning, or is it the broader Iran narrative?
I would say it's more of the broader Iran narrative. I think French political situation is very well known for markets, and we still have a long way to go towards the election. But what we are seeing right now is the widening of EGB spreads, the tightening of financial conditions across the board when it comes to Europe. Like BTP versus bonds actually is, we had it trading around 60 basis points ahead of this crisis. And, we have seen that when we do see a hawkish narrative from ECB, this spread should widen, right? People buy these products just because we know we have a central bank that's been easing rates. So I think that's the narrative that's actually driving the spreads wider across the EGB space right now.
Yes. I mean, when do you start to be nervous about the Italian BTP Bund spread, Pooja? Where are we? We're at 97 right now.
No, for me, actually, the 100 basis points was the critical level, and that was one level that I was just discussing on Friday, and we are inching that level very quickly. I think at 100, it is getting something that ECB cannot ignore. Again, it's not that high from a historic perspective, but the fact that the crisis is going so quickly and the fact that markets are actually pricing in 80 basis points in hikes from ECB is very punchy, right? And I think this is something that even LaGuardia said, that the starting point for this crisis is very different from 2022, right? The real yields at a very different level. We don't have that kind of free liquidity in the European or the UK market right now that we had in 2022. So for us to actually think that ECB can hike 80 basis points in this environment, it's a bit too aggressive.
OK, so April not live for you when it comes to the ECB, even though they've got a better growth backdrop than the Bank of England.
Well, we are eroding the growth backdrop, right, with this entire move in rates that we are seeing and the tighter financial conditions. Again, it's hard to say anything because, it's been 3 weeks and day by day the crisis is just getting worse, right? First week, we never thought we'll be at this level. So for us, it just makes sense for them to actually wait for the next forecast than overreacting, because the verbal part of the tightening in financial conditions is happening, right? For them, the key is to make sure inflation is anchored. And I think that's what they tried doing during the last week's conference.
Let's talk about the BOE as well. They've kind of shelved the easing plans. They've declared themselves ready to act. You've seen 10-year yields ending Friday 15 basis points higher. It's the highest close since 2008. We're waiting for them to open this morning. If you've got higher rates paired with fiscal largesse, which arguably the UK can't afford, how much higher do gilt yields climb?
Gilts is pretty much coming in a very weak picture right now. So far, I think it was all about the monetary policy last week. But I think right now we will actually, if we climb higher than the 5% level for 10-year, the concerns are more fiscal, to your point, right? So whatever the OBR fiscal buffers for 23 billion, they can be actually wiped out very quickly. A 1% move in gilt yields can wipe out around 18 billion in terms of these buffers, right? So that is eroding quickly. So for me, the key risk right now is that from a monetary standpoint, we have seen the bear flattening because everyone was pricing in hikes from BOE. This could turn into a bear steepening if markets actually think about the fiscal concerns returning back again, and the Rachel Reeves has to come back to this market again. But I'm hoping we don't reach that level. But 5% for us is definitely a very crucial hit when it comes to 10-year gilts.
OK, so we'll keep an eye in 25 minutes' time when we get the open of gilt markets then, Pooja, and what happens there. What about the central bank reaction function widely across Europe that you're expecting to see here? We heard a lot of tough talk last week. The purpose of that tough talk is perhaps, as you said, to try and keep a lid on inflation, to try and have the markets maybe do some of the central bank's tightening work for it? Is that the purpose of it? The more they talk tough, the less they maybe have to follow through with those hikes. Is that the idea?
Certainly. I think that was the first plan of action for most central banks who have been hit by inflation. I think BOE was something that markets really did not expect. That I think it was the first time since 2021 that they have voted unanimously for not doing anything, right? So for me, they would like this to work. But, this week we will see first set of PMI, something that you mentioned, and that will also show that the economy is weak. So it is getting a very different... Even the central banks cannot play the same playbook that we had in 2022 because growth is not at the same footing. For Europe as well, right? Germany has its fiscal buffers, but we are seeing weaker growth elsewhere.
And you had the Fed sounding a little bit less hawkish than the ECB and the Bank of England. How much would that, to some extent, put a lid on the dollar's gains from here on out?
I think at this stage, when you have something like a global event like this, dollar does get the dominance trade, and that's likely to continue unless, I don't think we are going back to the liberalization trade right now. So that dominance is still going to continue, and what we are doing right now is basically markets putting in those kind of hikes in US as well, right? Like if you see the front end, we were almost sold off 60 basis points. We were cutting, we were pricing in 50 basis points in cuts, and now almost 10 basis points in hikes. So we are looking for dollar dominance to continue, especially given the fact that Europe and UK are clear net importers of oil. They do have a current deficits that they have to deal with. So that gives US much more of a stronger position here.
OK, Pooja, great to have you back. Pooja Kumra there, Senior European and UK Rate Strategist over at TD Securities. Thank you. Well, we began with the politics. German Conservatives, led by Chancellor Friedrich Merz, have secured an election win in a socialist haven as he struggles to gain traction among voters. Meanwhile, in France, the far right fell short of taking control of some major cities during yesterday's municipal elections. Let's bring in now Oliver Crook, Bloomberg's chief Europe correspondent, to take us through some of those results. Ollie, good morning. So let's start with Germany. The victory softens the blow for the CDU after quite a stinging defeat in a neighbouring state. Tell us more.
Yeah, I think that's fair to say, Lizzy. That said, Rheinland-Pfalz, where the election was held over the weekend, is a much smaller state than Baden-Württemberg, where the CDU was supposed to win 2 weeks ago and, of course, then got edged out by the Greens. Another sort of blow to Friedrich Merz, who we have to say is a fairly unpopular politician who failed to get the votes of his own coalition lawmakers to get him into the premiership on the first day, which was supposed to be a rubber stamp vote. So this is really taken as a welcome win victory for the Chancellor of Germany. That being said, I'm not sure how much we can read into it. The party that he beat, that he edged out, the SPD, which we should say was in power for about 35 years, so significant, it's also their junior coalition partner. So they're also part of this government. We should also say that in this vote as well, we had the AfD get about 20% of the vote. That was a record for them, and that is not generally an area of Germany where they tend to be dominant. That being said, again, trying to add up all of these sort of slight victories for the Chancellor of Germany, who's had a real difficulty getting his political messages to cut through, really difficulty for all of the issues that have been adding up for the German economy. So he'll take that as a win. That being said, I don't think that macro speaking, in terms of the political picture within Germany, it changes things that dramatically.
OK, so that's the nuance there in Germany, Ollie. How about over in France? Marine Le Pen's national rally missed out on some of its biggest targets over the weekend in some local elections there. What does this mean ahead of next year's presidential election?
Yeah, I think everyone's watching this very closely. So these are municipal elections across much of France. And we should say that really the big piece of news was in Paris. Of course, this is the most sort of important city in France, a very sort of centrist, or I should say a very sort of centralized political structure within France. And it was the socialists that retained power there. Emmanuelle Grégoire, who will take over from Anne Hidalgo as mayor of Paris after she was in power for about 12 years. So the socialists remain in power there. That being said, across France, what we've seen is sort of an interesting picture here, where you did see the far right, the Rassemblement National, Marine Le Pen's party, headed by Jordan Bardella. They did gain significantly across the sort of aggregate in terms of popularity across France. That being said, as you mentioned, Anna, they failed to win a lot of the key cities that they wanted to sort of take power in. So they potentially did not get the kind of momentum to get them in power. So we're watching this obviously very closely ahead of 2027, the end of the age of Macron. And Macron's really big political feat was collapsing the center of French politics with the socialists and the right Républicain. Those all sort of went and flocked towards Macron and basically destroyed those parties significantly going into this election now in 2027, where it's anybody's game. Unlike Germany, in France, you know, it's a presidential system. There are these 2 rounds of voting. It's a lot more volatile, much harder to predict. It's, you know, watch very closely to see what we could get in 2027. That being said, 2027 is a long way away, particularly in French politics. But again, the sort of broad picture here is that the far right is doing better in France, but not really cutting through to the point of being able to win those key municipalities.
Ollie, thanks very much. Bloomberg's chief Europe correspondent Oliver Crook with the latest on those political dynamics. And politicians all over Europe very conscious of the difficulties within the energy markets and the inflation that could unleash. The International Energy Agency's executive director, Fatih Birol, has spoken about the widespread damage to energy infrastructure in the Middle East, potentially prolonging disruptions to global supply chains after the conflict ends.
We are following the damage on all the energy assets there. There are at least 40 energy assets in the region are severely or very severely damaged. Okay, and across 9 countries.
His assessment there. We will discuss more on the implications for the energy sector and the oil outlook later in the show. This is Bloomberg.
Fourteen minutes away from the opening trade. Good morning if you're just joining us. Here's what your futures picture is looking like in Europe. We are in negative territory this morning. The DAX in Frankfurt expected to suffer the most, but we've already seen losses in the Asian session and we're expected to see them as well in the US session. At the same time, we've just seen traders boosting their bets on ECB rate hikes this year. They now see a 50% chance of 4 hikes in 2026. So in the bond space, we're seeing yields higher across the curve across the continent, Anna.
Yeah, absolutely. Let's talk about what's happening in these markets. Our Markets Live executive editor, Mark Cudmore, joins us now with more. Mark, let me start with precious metals because we see gold and silver prices both down by around 6% right now on my Bloomberg screen. I mean, does this strike you as interesting, a continuation, really, of what we already knew about the role that gold and silver were playing in this particular war, in this particular crisis? But I guess it's interesting that this is happening once again, another Monday where this is the knee-jerk reaction.
Yeah, good morning, Anna. We're certainly seeing some short-term capitulation type price action in precious metals and some other assets out there. I don't think that this is the low, though. You know, as we've discussed a lot over the last couple of weeks, this should be a very negative environment for gold. All the marginal factors switched at the start of this month. We got a stronger dollar, we got higher yields, and if you were buying gold on the risk of a war in the Middle East, well, you got your war at the start of the month, and therefore it's time to pat yourself on the back and take profit. So all those things are playing out right now. There's no further escalation that you can reasonably bet on without something that's completely doom-mongery for humanity. So I think that, you know, gold should continue to decline. Now, very short term, this action looks like we've done a lot of the short-term stop losses. But I wouldn't be surprised if over the coming weeks, if the conflict continues, that we have another 10% or so downside.
Mark, what about this argument that you could see a comeback for gold when the sell the winners phenomenon is over and done with?
Well, I think gold has been selling off because of that dynamic, because the idea that, you know, it's somewhere where people have made a lot of money. You got to remember that gold, you know, while it's off whatever $1,300 or $1,400 from the highs, it's still up about, you know, $700 or more from where it was a year ago. I don't have the exact kind of rates in front of me, so it's still up over the last year, and that's the dynamic which is kind of driving this. That basically we are seeing just general deleveraging in the market. People are having to sell down their winners to pay for losers, and I think that's what's been driving gold at the moment. You know, probably after we get through the crisis and dollar starts declining again and yield starts softening again, people will get back on gold. Ultimately, the long-term desire to seek alternatives to the dollar and fiat currencies is probably still valid. It's just we won't return to that until the conflict is over.
Let me ask you about stocks then, Mark, because we're 12 minutes away here from a European equity session that looks as if it's going to be pretty negative. European futures down by 1.8% right now. The Xetra DAX, as it often does, could take the worst of that. But that's not necessarily the end of it, because US futures also pointing a little bit lower. This is starting out to be a negative session, negative week for stocks.
Yeah, look, we're having the worst month for global stocks in 3.5 years by some distance now. It's a pretty bleak month. Unfortunately, my view hasn't really changed. The last few weeks, I keep on saying it's bad, it's going to get worse, and I still think that's the case. As I said, it does feel like short term there's been a little bit of capitulation, so I have no particularly strong view in the next 24 hours. But the market is still positioned very optimistically despite this sell-off. There is still a belief that the conflict will end soon, the Strait will open up soon. I'm not going to tell people what's going to happen in the conflict. I don't think anyone's got a clue, including Donald Trump. So therefore, I don't know how anyone has conviction about it. What I do know is the asymmetric setup is for much more declines to come. To be contrarian right now is to stay being bearish even after these sell-offs.
OK, Mark Cudmore there, our Markets Live executive editor. Thank you very much. And remember, you can get up-to-date analysis and insight from Mark and the rest of the team by going to MLIV Go on your terminal. Let's go to your stocks to watch now with Bloomberg's Jennifer Creary. Jennifer, what are you watching?
Good morning. We're going to kick off today with a bit of M&A action, and that comes from Poste Italiane. Poste Italiane said it will launch a voluntary public offer for Telecom Italia valued at 10.8 billion euros. Now, Poste Italiane is seeking full control of Telecom Italia, and the move would set it up for a delisting. Now, the deal would turn Telecom Italia's largest shareholder into its owner. It would also bring Telecom Italia's network, cloud and data into Poste's broader platform. Now, that move would align with Italian Prime Minister Giorgia Meloni's push for closer oversight of strategic infrastructure. So we're keeping an eye on those two stocks at the open, in particular Poste Italiane. Next up, we've talked a little bit about precious metals, and we're going to focus on the miners this morning. That's after gold fell for the 9th day during Asia trading, reversing some of its record high gains since the start of the year. Glencore, Antofagasta, Rio Tinto, Anglo American in focus on the open, and that comes as investors investors are concerned over the inflationary risk arising from the Middle East conflict, as well as the prospect of higher interest rates. So we're keeping an eye on those shares as well. Finally, we're going to end on Volkswagen. That comes after the CEO said in an interview with a German newspaper that restructuring will continue. Now, as you can see, over the past year, Volkswagen has been on a very volatile ride. That comes as the car maker looks to restructure, to cut costs in light of higher competition from Chinese players, but also higher costs in the electric vehicle space. We have a quote from Oliver Boom saying that our energy costs are too high and there's too much regulation. So Volkswagen shares will also be in focus at the open. Back to you.
Jennifer, thank you very much. Jennifer Creary with a look at some of the stocks and indeed individual stocks that could be in focus. Let's think about where we are on the commodity markets then, Lizzy. We are up by 1.6% on Brent, up by 3.4% on WTI. I mean, that's interesting in itself, isn't it? It seems as if the US-focused market, the US-focused benchmark, is paying more attention to the rhetoric now than it was a couple of weeks ago. We spent a lot of last week, talking about the divergence. Maybe Brent would go higher and WTI would be a bit more insulated from that upward downward pressure. That does not seem to be the case this morning.
And it's interesting that you've seen wild moves in the bond market, but not so much when it comes to oil, but still 114 notable, and that could set off a risk-off mood in the European stock session today. And indeed, that's what the futures picture is suggesting we're going to get. Euro Stoxx 50 futures down nearly 2% now. A particular weakness for Germany expected, but we're in the red for the FTSE, the CAC and the FTSE MIB in Italy as well.
Yeah, absolutely. So that's where the equity markets will be heading. Thinking about where we are on these energy markets, I mean, the fact that we've got WTI now over $100 a barrel, I read at least 2 notes this morning suggesting that this might be significant for the narrative over in the US as President Trump focuses his mind on higher energy markets, energy prices a little bit. What can be done about that, I don't know. But the fact that we've gone above $100 a barrel on WTI does seem to be interesting. But the broad, as you say, the broad move is that we are not seeing enormous amounts of movement higher at the short end, at least, of these curves. So if we look at gas markets as well, natural gas price up by 4% for the Dutch benchmark this morning, which by recent standards is quite constrained. But if you look further out the curve, certainly on the Brent curve, if you look further out, you're actually seeing more movement to the upside, all the way out to 27, 29, some of these futures going higher, as if it's not necessarily a near-term conclusion that has shifted this morning. It's something about the longer term, something about the damage created in the Middle East and what that's going to do over the medium term to energy markets.
Arguably, it's because we've seen oil prices rising, even in the US, that President Trump is under so much pressure to put pressure on Tehran, to put out that Truth Social post saying, Tehran, you've got 48 hours to reopen the strait or have your plants bombed.
Yeah.
But then when Iran responds and you're seeing infrastructure damaged on both sides, on Gulf nations and Iran as well, that's what prolongs the crisis in terms of when we get back to the normal oil flows and pushes oil prices even higher.
Yeah, absolutely. So European equity market futures pointing lower, US futures still pointing lower, down by 1.1% on Nasdaq futures. We keep in mind what's happening in bond markets as well, because this can add a different complexion to the equity session as well as we wait for that to start. On the bond markets, we are seeing those yields going higher once again after some fairly substantial moves higher during Friday's session for yield. So bond selling, equity selling, certainly the stories of the moment. We'll be back with the opening trade for this Monday morning. This is Bloomberg. Welcome back, everybody. This is the opening trade for this Monday morning, and we are expecting to see negativity at the start of the European trading day. At this time of a Monday, often we ask ourselves, how much does Friday matter? How much does what we saw on Wall Street on Friday really matter for European equity markets? Well, perhaps it does a little bit today, because we did see considerable selling into the afternoon over on the United States, on Wall Street. And so we could see some of that negativity influencing what happens here in Europe, especially as the rhetoric, the build-up in rhetoric between the US and Iran has also lent in a negative risk direction. And so both of those two factors conspiring together to suggest that we will go weaker at the start of the European trading day. Let's have a look at the European futures picture, which is considerably weaker this morning. So we are expecting to see some pretty heavy selling. Maybe the DAX gets the worst of that. You saw it briefly, then it disappeared. We are expecting, Lizzy, then that the markets across Europe will be negative overall. The DAX could get the worst of it. The FTSE could be a little cushioned by some of the basic resources.
Yes. In terms of some of the individual stocks that we're watching this morning, Anna, we start with a bit of M&A action. You've had Poste Italiane saying that it's going to launch a voluntary public offer valued at about 10.8 billion euros for Telecom Italia. So they're seeking full control of this former phone monopoly and setting up its delisting. Then we're watching the miners as well, because we've seen gold and silver tumbling on the inflation fears around the Middle East war. Copper also at its lowest in more than 3 months. And then Delivery Hero in focus as well. Gaining on TradeGate, it's agreed to sell its Food Panda operations in Taiwan to Grab Holdings, which is, of course, backed by Uber. That for about $600 million. So 3 to watch there for you, Anna.
Yeah, absolutely. So, Lizzy, we focus in on the negativity that we saw on Wall Street on Friday, the rhetoric over the weekend between Iran and the United States. All of it centered around the Straits of Hormuz, of course. We also focus on an Asian session that's been considerably in the red, down by more than 3% on Asian equities. But part of that was Friday's story. Part of that was the negativity that we saw on Wall Street in Europe during Friday's session. So what will we see here in Europe today? The Stoxx 600 does seem to be wanting to open in negative territory. I can't tell you a lot of detail about just how negative, but it does seem as if it wants to open in negative territory. The FTSE could be a little cushioned then, Lizzy, as we've been saying, because of the makeup, some of the oil majors in the mix there. Maybe we'll get more negativity coming through on the German market. There we go. We've got the German market yet to open, as our graphics seem to want to have a life of their own this morning. Lizzy, what have you got for us?
Well, they're feeling very Monday. It's red across the screen for European equities. We've got the Stoxx 600 down 1.3%, the FTSE 100 down 1.5%, the CAC 40 about the same. We're waiting, as you say, for the DAX in Frankfurt. But if we look at the individual sectors, again, everything in the red. Bottom of the basket, utilities, technology and industrial goods and services down as well, all by more than 2%. The best performer is construction, autos and parts as well, but still they're down by more than 0.6% this morning. Now, we can check in on some of those individual movers that we'd been flagging. We said that the mining names were ones to watch, given, of course, the moves on copper, in gold and silver as well. And so we've got red across the screen yet again for those as well. So BHP, Anglo-American, Glencore, Rio Tinto, all down this morning. BHP by 1.4%, but the rest down more than 2%.
Let's get a quick check on what's happening on gilt markets then, Lizzy, because we were primed for something fairly dramatic at the start of the trading week because of what had happened on Friday, because of the conversations all through the weekend and the narrative coming out of the Middle East. So the UK two-year bond yield rising to its highest since February 2024. So that's the short end of the UK curve, where we see those gilt yields, yes, rising by 8 basis points. We see a rise at the 10-year horizon of 6 basis points. I mean, we saw substantial moves and bigger moves than this during Friday's session, but this is just another day of these yield moves to the upside.
And indeed, traders now fully pricing 4 quarter-point Bank of England hikes in 2026, not adding up with the message that we've been hearing from analysts that this just isn't possible to be hiking rates so much with such a weak growth backdrop in the UK.
Yes, and I think even the Bank of England governor suggesting that perhaps the market had got a little ahead of its skis, pricing in quite so many hikes when what we've got from them was a definite pause. Let us have a look at where we are on the broader market conversation this Monday, 23rd of March then. Let's bring in Maria Minucci, who is multi-asset fund manager at M&G Investments. Maria, good morning to you. Nice to have you with us. One of the questions I'm thinking about this morning is the extent to which you want to be invested, the extent you want to be in cash. I was listening to Warren Buffett talking just days ago, talking about how if this is prolonged, if you're talking about medium-term investments, maybe you want to stay in stocks, stay in the real economy, not in cash. But you maybe take a different view. What are you thinking about?
Well, our positioning going into this situation has been to have a relatively neutral exposure to equities, but with a very strong preference for markets outside the US. So within that neutrality in equities, actually having some very specific bets, for example, in Asian markets, which, even after the strong volatility we've seen in the past couple of weeks, they're still up considerably over the years. If you look at markets like Korea, for example, we have seen some very strong returns there at the end of 2025 and again into this year. What we've also entered this phase with is actually a relatively large amount of cash. And that has been very helpful in a situation in which actually we haven't had many assets diversifying out in this phase. And very interestingly, even assets that in 2025 had seen as a potential diversifier like gold has proven actually to be very unreliable in this phase. The dollar, I would say, has probably been the only area where we've seen a bit of diversification. Certainly not on government bonds, although it's still an area that we do like. And we think that maybe this reaction into this latest week has been a little bit overdone and might present some opportunities as well.
OK, so interesting. So you keep some cash and you say that means that when you see dislocation in these markets, you're able to reinvest. I mean, have we seen dislocation that encourages people into these markets? And if so, which assets?
Well, I think what we've seen so far has actually been a very measured response to a development of events that is pretty important for the global economy. Obviously, in different ways depending on the different regions and how reliant they are on oil or on gas. But certainly a very, very important set of events from an economic standpoint. And the reaction so far, especially in equity, I would say has been relatively muted. Obviously, today we're seeing a little bit more volatility. But if you look at also the markets that have sold off the most, are actually those that have gained the most in the previous weeks and months. So there's been a sort of profit-taking more than complete risk-off on this market. So at the moment, we don't see opportunities to re-engage yet in the equity complex at large. Obviously, there might be some selected opportunities. For example, Indonesian equities have been particularly weak. So at the margin, I think a little bit of diversification there. But all in all, I think the response has been very muted. Where it has been less muted has probably been on government bonds, where we have seen a reaction function that was very significant. Obviously, there is risks of inflation reaccelerating, and the energy drive. It's very important, both from a direct consequence, but also the indirect consequence towards inflation. But the move we're seeing is very, very significant, and I think it might start providing at the edges some opportunities, especially because it feels like at the moment the market is pricing in this inflation risk, but is not really pricing in the growth risk that could come with it should this tension and conflict remain quite extended.
Well, we've got loads of PMIs coming out this week. Do investors treat it, if they're weak, as bad news for earnings or good news because it kind of takes off some of the pressure for central banks?
Well, it's a very good point, because at the moment, actually, we have seen this resurgence on interest rate expectation from a monetary policy front. So going from, stable monetary policy into 2026 in places like Europe, or, reducing rates to increasing rates significantly for 2026. And normally you will expect, this type of shift to have an impact on equities as well. But we haven't actually seen a lot of it so far. So I think it will be interesting to see, how the market takes this. And it's going to have a balancing act, especially given where governments are today from a fiscal standpoint. If you go into the economy and I correct significantly to respond to the inflation threats, then you're going to have to respond to support consumption in different ways. And not all governments are in the right shape to be able to do that like they have been doing in the past. So I think you will find a lot of tension between interest rates and fiscal expansion within government.
Especially in the UK. And we had gilt yields up last week. They're up again this morning. You're looking at the 10-year gilt yield up 5 basis points, the 2-year up 7 basis points at 4.6% this morning. And yet you see opportunities across the gilt curve. Where?
Yeah, I think, especially in the belly of the curve, we have seen such significant increase in yields that they make us think that potentially you have some opportunities. Again, the market is pricing in more of an inflationary risk than it is a growth risk for that market. And I would say gilts has been the epicenter of that volatility within bonds. But actually, if we look at other areas like BTPs in Italy, they've also seen quite a significant sell-off and move in yields. So there is potentially opportunities if we look in a longer-term perspective. Obviously, we're very careful of not making any focus around how things will play out. But there are different scenarios, and then we're trying to understand what type of weight is the market giving to the different scenarios. And I think at the moment, the one that seems less likely from a market pricing standpoint is this deterioration in growth. And maybe because we have seen in the past that, if we look back at 2022, you had an inflation spike, but then growth actually remained pretty resilient. So despite the volatility you had in equities in 2022, you then have some very, very interesting returns in the asset class. So many investors might be less willing to step back, knowing that eventually you will get good returns.
So you think it's going to be different this time then? It's going to be, the growth impact will be bigger compared to what we saw in 22, because bond markets do seem to be reacting just to this inflation concern, don't they? Is it just a question of time then, Maria? We just, in the end, we are going to pivot from inflation concerns to growth concerns on bond markets?
Well, it depends on many different factors, so we're not positioning ourselves for that scenario alone, but we do consider that as a possible scenario, which I think is something that the market is less inclined to, and so that's where we find opportunities at the margin. But we also have to say that we started this phase from a relatively strong growth backdrop, especially if we look at the US and the fiscal stimulus ongoing there. Oil prices was particularly low. We had a phase of oversupply in oil, so I think that also made it so that it took a little bit of time for the oil price to respond in a more aggressive way to the events that then took place.
If we can just come back to stocks, you can see there the FTSE 100 into correction territory, that headline just crossing the screen there. But you mentioned that you're underweight the US. And actually, you've got some saying that we're getting to the point where big tech becomes irresistible. You're questioning how insulated it actually is from geopolitics. But because the Mag 7 is putting up these superior earnings and continues to, park NVIDIA for a second, you've got some saying now's the time to buy.
Well, I think it's been a super interesting behavior of this part of the market in the last few months, because if you look at US equities, they've actually gone sideways for many months now, and they've been more resilient so far in this phase of volatility. But even within the tech sector, you have some very different behaviors. If you think about software at the beginning of the year and how much weakness we've seen there, and then actually in this latest phase of volatility, it's been a lot more resilient. So we have seen some opportunities within this sector to be able to add on a stock-specific basis. But overall, I think, the AI story, although it's got a lot of capital and strength behind it, is not going to be completely insulated by these trends, because there are elements of supply chains that might be impacted. There are elements obviously linked to the energy complex that, this sector is not completely insulated from.
Maria, can I ask you about corporate credit? We've seen spreads quite tight, of course. I wonder what you think about corporate credit right now. And if you don't like it, is it because of those spreads where they are now, or is it the risk around private credit and how we could see, some contagion really from the private credit markets into public credit? What are you thinking there?
I would say the starting point is the credit spreads and the levels that we're seeing today. We don't feel that you're getting compensated enough for the type of risks that we're seeing, in the environment. And specifically, this has been exacerbated by what has been happening on the private credit side and, some of the early accidents that we've seen there. Obviously, it's not a complete given that you're going to have a spillover onto public credit markets, but it is the more liquid part, of that complex. And so if people have to de-risk, there is a possibility that will be the area that they will look at. I think an interesting way to play this is to be long the physical credit. We have a very strong team of fund managers that, can deliver alpha in this market still, but at the same time edge the overall credit spread, so edge the beta and give us that possibility to then reopen the trade when we think there is opportunity, even in a market that is potentially less liquid.
Maria, thank you. Thank you for coming to see us. That's Maria Muniki, multi-asset fund manager at M&G Investments. Let's check in on the Core 6, shall we? It is, of course, red across the screen for the Stoxx 600, as it is for the Core 6 this morning. Particular losses for Rheinmetall out of Germany, also for Novo Nordisk. But as I say, every sector is in the red this morning on the Stoxx 600. This risk-off mood as we have the tensions heating up in the Middle East. Let's get a check on some of the individual stocks that we're watching as well with Jennifer Query.
Good morning, that's right. So we're seeing some of those, the impact of the fall in gold prices affecting some of those gold miners. We've got Antofagasta and Fresnillo down more than 3% on the open. That's, of course, as investors sell off from war in the Middle East. And there's growing concern over the risk of inflation, but also higher interest rates. And we can see that bleeding into some of the mining stocks this morning. Next up, we've also got an eye on Telecom Italia. Telecom Italia rising on the open, up 4.7%. Poste Italiane down 5.6%. That's after Poste Italiane said that it will launch a voluntary initial public offer for Telecom Italia valued at 10.8 billion euros. Those shares diverging on the open off the back of that bit of M&A news. Next up, we're going to flip over to Salzgitter. Salzgitter falling 6.6%. That's after the company, which produces steel products like steel tubes, reported sales that missed analyst forecasts. It reported a full-year loss of 70 million euros. Investors clearly unhappy with that performance. Finally, we're ending on ING. ING, the Dutch financial institution, falling 2.7% on the open. That's after it was cut to equal weight by Morgan Stanley analysts. That's part of a broader Morgan Stanley note from analysts turning more defensive on European banks. ING, one of the losers this morning. Back to you.
Jennifer, thank you. Jennifer Creary with an update on some of those individual movers. And there are some that are not responding to the broad risk-off theme that we see in markets. But overall, we see European equity markets then considerably weaker, down by 1.6% on the 1.5%, sorry, on the Stoxx 600. The FTSE a little cushioned, the AEX a little cushioned by what we're seeing broadly, Lizzy, across these markets, but not really. I mean, energy stocks not performing the role they did last week, which is interesting in itself. So last week we saw energy stocks doing pretty well when other stocks didn't. And today we see energy stocks down by more than 1%.
Yeah, they're the second best performing sector of a basket of every sector being in the red. Consumer products and services lead the gains, energy in second place, but bottom of the basket, basic resources. We expected this, didn't we, given the moves that we've talked about in gold and silver to the downside. You are looking at gold weaker 5.4% now at $4,250 a troy ounce. And then when it takes you to the miners, Fresnillo down 3.7% as a result. Well, coming up, we have the IEA saying that more than 40 energy sites have been damaged by the Iran war. We'll discuss the implications for the sector next. This is Bloomberg.
Welcome back. This is the opening trade. Another Monday of negativity across these equity markets. So we're down by 1.7% across European stocks, and all sectors are in negative territory. The worst performing is real estate, but down by 2.5%. The impact of higher interest rates in these markets perhaps having an impact there. Let's talk about what's been happening in the Italian communications space, because there we see some considerable movement in these stocks. This after Poste Italiane said it will launch a voluntary public offer valued at 10.8 billion euros for the former Italian phone monopoly. That is Telecom Italia, of course. Joining us now for more is Bloomberg's Daniele Lepido, who is in Milan for us. Daniele, good morning to you. So what does Poste Italiane's bid mean for the future control of Telecom Italia?
Good morning from Milan. Telecom Italia is still in the spotlight again and again. And yesterday it was an early spring, late Sunday evening when Poste Italiane surprisingly launched this bid. What it means? It means that the state is coming back into the economy. It means that Telecom Italia, after about 3 decades from the privatization, is coming back to the state. And Meloni government, as we know, is tightening the grip on a pretty strategical services and infrastructure like Telecom Italia. We also need to remember that last year, Telecom Italia completed the sale of its most valuable assets, so the network, to KKR. So what the Prime Minister Meloni wants to do is creating a fully integrated digital hub inside Poste Italiane. Please remember that Poste Italiane is a huge conglomerate with many services. It also owns and also a so-called virtual mobility network, a virtual mobility of phone operator. So the meaning is creating a big digital platform to compete with other bigger rivals in Europe.
So, Daniele, why is the government backing this kind of consolidation now?
Yeah, that's a good question. I think that this move by Poste Italiane could kick off a wave of consolidation among carriers, phone carriers in Italy. As you know, Italian telecommunication market is one among world's most competitive with very low prices. And in 2018, French Iliad entered the market and lowered again the prices. So let's see what's going to happen. But I think that all analysts agree on the fact that Italy needs to have 3 carriers rather than 4.
Thank you very much. Thanks for joining us, Daniele. Good to have you on the programme. Bloomberg's Daniele Lepido joining us there from Milan. And we'll have more on this story as we bring you an exclusive conversation with the Telecom Italia CEO. That is coming up tomorrow, in fact, 9:30 a.m. London time.
Meanwhile, we have oil moving higher as investors assess President Trump's ultimatum to Iran to reopen the Strait of Hormuz, and Tehran's threat of more reprisals is being described as the largest ever supply shock for global crude markets. And Will Kennedy, our EMEA News Director, joins us now for more. Will, let's say that this deadline tonight, it's 15 minutes before midnight London time, comes and goes. What happens to oil prices then?
Well, oil prices are still grappling with the fundamental fact that the Strait of Hormuz is still largely closed and presumably will remain largely closed after that deadline. I don't think anything fundamentally changes for the oil market, apart from the fact that this conflict will continue to seem intractable. If Trump follows through on his threat, however, it will be an enormous escalation, especially given the threats that Iran has made to retaliate against assets across the Gulf, including energy assets, and it will make a resolution to this conflict seem further off. So in either scenario, unless Iran capitulates and says, yes, we're going to open the straits, which I don't think anyone expects based on what we've seen from Tehran so far, it's a question of will oil go a little bit higher or a lot higher.
Yeah. OK. And it is going a little bit higher at the moment, isn't it? Well, I mean, given the equity markets seem to be responding as if we got a lot of new information over the weekend, and a lot of it was negative. US futures pointing down by, well, it was just shy of 1%. Now a little better than that, but still pointing quite negative. Oil prices just making very modest moves to the upside. But interesting on the Brent curve, if you look further out the curve, actually, we seem to be seeing more response and prices going higher further out the curve over the next year or couple of years. Does that give us a sense that maybe the market is increasingly thinking about the longer term impact of this?
I think if we look at the market reaction across the board today, clearly it's about pricing in the fact that this conflict isn't going to stop anytime soon, and even if it does, there won't be a clear and quick resolution to the problems that we've seen build up through the global energy system over the last few weeks. I think many traders at the start of this conflict thought it would be short-lived, and you saw a lot of people trade oil on that basis. But as we get longer, the dislocations through the global energy system get worse, and the time it will take to get things back to normal increases, which is why we've seen the sort of pricing action further out that you described, Anna.
And indeed, in terms of that retaliation, you've had Iran just threatening to mine the Persian Gulf if its islands and coast are attacked. So it's only a heightening of the rhetoric on both sides coming now. Usually, when it's Sarah week, Will, we would be talking about that when it comes to the oil market. But of course, the focus is on the Middle East. Is there anything that we should be watching out for in particular there?
It's an interesting moment for the shale industry. Obviously, these prices are allowing the shale industry to sell forward a lot of its production at higher prices. So it probably means that those concerns about production in the US that we talked about from time to time about shale slowing down, peaking, it probably suggests that it's giving the financial framework for the shale industry to continue drilling, to continue trying to exploit those resources as much as possible. So it's probably fairly bullish for the outlook. But of course, the other big question for the US is ratcheting higher of product prices. We talked a lot about diesel at $5. We've got gasoline at $4. And the economy in the US is very sensitive to these prices, especially when it comes to consumer sentiment.
Yeah, and interesting that we do see WTI moving as much, if not more, than Brent today, because last week we talked about a divergence. The
divergence was incredibly stark. We saw the spread between WTI futures in New York and Brent futures in London blow out to levels much higher than we normally expect. And there are reasons for that. Clearly, the US is more self-sufficient. It's to do with the types of crude that are produced in both countries. But there was always going to be a bit of a catch-up, and the US administration has been really keen to keep a lid on WTI prices, but there's only so much can be done.
Yeah, absolutely, and today we see them go over $100 a barrel, so 100 spot 29 is where we trade right now. Thanks very much, Will, for bringing us the analysis. Bloomberg's News Director for Europe, Middle East and Asia, Will Kennedy. Coming up on the programme, we speak to Barclays Chief US Economist, Mark Giannoni. We'll get his take on the Fed, the US economy in the context of war in the Middle East. That's next. This is Bloomberg. Welcome back, everybody. 30 minutes into Monday's session, and the European equity markets in the red, firmly in the red, down by 1.9% on the Stoxx Europe 600. The Xetra DAX getting the worst of the losses this morning of the major markets, down by more than 2%. The CAC 40, the FTSE 100, though, not far behind. And that's interesting that the FTSE 100 is selling off almost as much as some of the other markets here, because it had been cushioned by the resilience of the energy sector in recent trading days. Energy is kind of resilient today, but it's still in negative territory as a sector, as an equity market sector. And so that is something that is a little bit different from what we saw last week. Lizzy, what are you seeing under the hood in these markets?
Well, that negativity is pretty universal this morning. As you can see here, we have got volumes higher, but 579 members are in the negative territory today. Only 19 managing to eke out gains this morning. So reflecting what you've just shown us across the continent when it comes to the geographical breakdown. Let's have a look at the leaders and laggards this morning. Some of the leaders include Telecom Italia. We had that Poste Italiane offer earlier. So Telecom Italia up 5.4% at the moment. It's the reverse for Poste Italiane. BP, meanwhile, because we have got oil prices higher, but BP shares actually down 0.3% following the risk-off mood elsewhere. And Pandora shares up 4.3% this morning. We've seen precious metals moves, significant moves, and so Pandora up 4.3%. Let's take a look at the laggards as well. Siemens Energy is down 3.2% at the moment. ASML down 1.2%. You've seen that AI tech sell-off. And then Rolls-Royce shares down nearly 5% because, of course, we have continued reduced air travel, Anna.
Let's talk about some of the individual stories that we're focused on this morning. And LaGuardia Airport is closed this morning after an Air Canada Express flight with 76 people aboard collided with a vehicle shortly after landing. Police say the aircraft hit a Port Authority of New York and New Jersey ground vehicle. NBC News is reporting that both the pilot and co-pilot died in the collision. German Conservatives, led by Chancellor Friedrich Merz, have dislodged the Social Democrats from power after 35 years in the southwestern German state. The win comes as Merz struggles to gain nationwide traction among voters. And meanwhile, in France, Marine Le Pen's national rally fell short in its bid to take control of a host of major French cities in Sunday's municipal elections. In Paris, socialist Emmanuel Grégoire was on course to win the race for mayor, extending the left's quarter-century hold on the French capital. And the US and Iran are trading threats as the conflict enters its fourth week, showing no signs of de-escalating. US President Donald Trump issued Iran a 2-day deadline on Saturday to reopen the Strait of Hormuz or face its power plants being bombed. While Iran's National Defense Council is reportedly saying that the entire Persian Gulf will be in a similar situation to the Strait of Hormuz if there's an attempt by US or Israel to attack Iranian islands or its coastline. Lizzy.
Well, the turmoil in the Middle East has sparked a rise in Treasury yields, with more traders pricing in a chance of a Fed rate hike by October, amid the concern that a protracted conflict could stoke inflation. Joining us now for more is Mark Giannoni, Chief US Economist at Barclays. Mark, good to have you with us in the studio.
Thanks for having me.
You don't think that's right. So I've talked about what traders see. They're pricing out Fed cuts this year. They're raising bets of a Fed hike by October to 50% as of Friday. But you see the Fed cutting in September and then again in March 2027. Why are they getting it so wrong?
Well, I mean, it's always difficult to say that the market is wrong because obviously the market takes incorporates a lot of information. But we do think that the Fed is going to cut this year, in September most likely, and then again in March 2027. And the reason for that is that it's true, oil prices are pushing up headline inflation, but core inflation in the US is unlikely to move up a lot, at least if oil prices remain roughly where they are, and they are, according to the futures, also gradually declining after that. Headline inflation typically responds very quickly. But then we experience disinflation once oil prices have stabilized. And then core inflation, as I said, is unlikely to move very much in the near term. It's more gradual. And then there are also disinflationary pressures affecting core inflation at this point. Tariffs effect have largely passed through, and we think their effect are going to gradually come down from here. The housing inflation is gradually coming down as well. And services inflation is not growing fast. And in part, this is because wage growth has largely stabilized.
But at what point, where does oil have to get to for you to be more concerned about inflation?
Yeah, so we would need to see oil prices remain very elevated and potentially continue to rise and in a very persistent fashion. And that's where we would see core inflation gradually move up and stay elevated for some time. And if this realizes, we are unlikely going to get the rate cuts. Actually, Chair Powell said as much last week. The FOMC also seems to expect a decline in rate this year as well as next year. But Chair Powell also said that this is conditioned on inflation gradually coming down.
So you still then expect that there will be a cut to Federal Reserve interest rates then, right. Mark, good morning. What about the rest? Where does that leave the rest of the world? Because are we going to be pricing something very different in Europe to the US, or will they converge to some degree?
Well, we think in that case they would converge most likely. So our European team expects the ECB to raise rate later this year. And so that would lead to some slight convergence in rates. I mean, we're not talking about very large move, both from the ECB or the Fed. I mean, if the Fed cuts, it's probably no more than one cut this year, unless the labor market suddenly deteriorates. And we've seen lots of fluctuations in the spread between the policy rates in the US.
And what do we need to know about the dual mandate of the Fed? And because that obviously sets it apart from some other central banks. When these mandates are in conflict, they need to prioritise the labour market. Is that the case? And to what degree, do you think? When will that start to become a valid or an important factor?
You're absolutely right. So in the US, the dual mandate is absolutely critical. I think what the Fed does is looking at to what extent inflation deviates from their target and the labor market or the unemployment rate, let's say, deviates from what they assess to be the normal rate for the unemployment rate. And over, what's the persistence of this deviation from that target? So if we did see a sudden increase in the unemployment rate, the Fed would very much focus on that, we think, on that part of the mandate, because they know that if the unemployment rate suddenly rises, it's going to take some time until the unemployment rate comes back closer to what they think is the longer run neutral. Whereas in this case, the inflation spike is more likely to be quite short-lived if it really turns out to be that oil prices stabilize.
And how long does the war have to go on for you to even start thinking about a recession in the US?
Yeah, so a recession, so we don't think a recession is a very likely outcome at this point. It's definitely not in our baseline. A recession always is possible in any given year with maybe 15-20% probability. We think we would need to see further rise in oil prices, very persistently so that the consumer spending, which is already, we think, on a downward trend, suddenly falls more abruptly. Again, we think the fundamentals in the U.S. economy are still show a lot of resilience. So we think it's unlikely that we see a very abrupt decline in consumer spending. But if we did see that, we would likely see a pickup in the unemployment rate, and all sorts of other recessionary dynamics might kick in.
Okay, so that's the outside scenario.
Right.
Again, you are expecting the Fed to cut in September. How much does that come down to the change at the top, the idea that we might be getting Kevin Warsh? Will the Fed's reaction function change if he is the Fed chair?
Great question. I mean, we don't think that the change in the leadership of the Fed would dramatically change the policy reaction function, at least in the near term. The monetary policy is decided by the entire committee, so 12 policy members. And the other FOMC voters are pretty independent in their thinking, and they like to maintain that independence. So I think it's going to be very difficult for a new Fed chair to radically change the policy reaction function. And besides, I mean, assuming that Kevin Warsh gets confirmed in the next several months, we don't think he's particularly dovish either. Historically, he has been more on the hawkish side, so it's not clear that he would push for many more rate cuts than what the FOMC wants.
It was clear from the last Fed meeting then, Mark, that the Fed is watching for inflation to come down as a result of the tariff effects dropping out. What role is AI going to play in complicating that inflation dynamic in the US? Because we've seen, before we were talking about, always and everywhere about the Iran war, we were talking about AI all the time. And we were talking about a huge amount of capex and investment going into AI. And some have suggested that in the short term that might be inflationary. On the other hand, job losses. So what's your latest take on what this does to the short-term and medium-term outlook for the US economy?
Yes, very well. So I think in the short term, as you alluded to, I think it's more inflationary in the sense that it creates more of a drain on resources. There's more employment involved in building the whole infrastructure related to AI. Actually, we think it contributed a lot to spending last year in terms of equipment, computer-related equipment, data center, software investment as well. So that involves a lot of activity, employment, and also slightly inflationary as it requires more resources to be built. Longer term, it may well be disinflationary in the sense that it improves productivity, and over time we may be able to produce more with fewer employees, and it may dislocate the labor market. But this is a much longer horizon, we think, than the near term that we are talking about. So when we talk about like 2026, 2027, we think we are not yet going to see all of these disruptions to the labor market or the disinflationary part.
But how much do you think that AI boosting productivity growth will raise the neutral rate?
For policy rates. So we think there is a chance that over time, to the extent that growth rate of the economy is going to be boosted by AI, but this is, again, over longer term, that it would eventually lead to a higher neutral policy rate. But there are other factors going against that. So demographic factors are really important in the US, as the labor force is now pretty much flattening out as you see more and more people moving to retirement. We are seeing also other factors that are contributing to potentially the lower policy rate over time. But AI could be an offset to that. So we think, again, this is something that would happen a few years down the road, not in the near term.
Mark, what's the risk to the scenario that we've just discussed? What's the risk to the fact there's no recession, that you get one rate cut, though, coming through in the US? What's the biggest concern? Is it to do with the Middle East, or is it something more domestically generated?
I think in the near term is very much the Middle East. Nobody knows, I guess, what the outcome of this war is going to be, how long it's going to last, how elevated the oil price shocks could be, and for how long. So I think these are all huge question mark, and Chair Powell alluded to that during the last press conference. So we think if oil prices remain much more elevated than in our baseline, so more elevated now and don't experience this decline than that the futures seem to indicate, then I think we could see at the same time more inflation and more of a downturn.
Yes, Chair Powell was also very clear, saying they don't have a huge amount of conviction about their forecast for the rest of the year because of all of those uncertainties. Mark, thank you very much. Thanks for coming to see us. Mark Giannoni, the chief US economist at Barclays. Now, the chief executive of UBS says energy prices are likely to stay elevated as investors digest the impact of the war in Iran. Sergio Amotti spoke exclusively with Bloomberg at the China Development Forum in Beijing.
This is basically the biggest topic we have been discussing lately. Of course, the good developments of China are somehow on the side for the second. But, when I go back to that, I do believe that China will continue to have a pretty good growth driven by innovation and the desire really to address also the topics of climate through innovations. And so, but in a sense, that kind of growth may be derailed by what's going on right now in Iran. Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain. And in that sense, the situation is a little bit unstable.
We're into the fourth week of this war with no end in sight, really. There's ultimatums out there. There are surely mitigation plans being put in place by businesses. What do you see as the direct cost to your business and your clients right now? And with no end in sight, how does that translate to mitigation advice?
But we saw clients already diversifying their portfolios early on this year. You saw much more dispersion in the way they were looking at maybe shifting away from more the AI technology to a more diversified portfolio. That was a good move considering what we see in the last few weeks. At this stage, clients are still, broadly speaking, calm. We don't see any major shift in asset allocation, but of course, this pressure that I mentioned before on the economy will start to weigh into the market.
The UBS CEO Sergio Ermotti speaking exclusively there to Bloomberg's Stephen Engel. Well, coming up, we'll bring you more on the broad market sell-off as we dive deeper into today's moves and look ahead to this week's macro events. We are very negative here in Europe. The Stoxx 600 down 1.9%, but it is red across the screen for European equities as we see oil higher at 114 on Brent, up 1.7%, a risk-off mood around the world. Stay with us. This is Bloomberg.
Welcome back to the opening trade. We are 49 minutes into a European session this Monday morning that looks really quite negative for European stocks, down by 1.6%. The FTSE 100 a little protected, perhaps. The CAC 40 a little protected from what's going on, but not as much as it was last week in the case of the FTSE. The Xetra DAX getting the worst of the selling, down by 1.8%. And if we look stateside, Lizzy, we see US futures are also weaker, suggesting that this has another day, perhaps, to go.
Yes, indeed. But let's get some analysis. Skylar Montgomery-Koenig from our Bloomberg Markets Live team joins us, as well as Rod Turnbull from Bloomberg Intelligence. Welcome to you both. Rod, I'm going to start with you talking about the equity picture. There's an interesting piece from our colleague Michael Masika on the terminal today, saying that, and this is according to a survey, market strategists are quite sanguine actually about the inflation fears because of the war, and they expect European stocks to return to record highs. There's a nice quote in here from Bank of America saying that the level of bullishness on European equities is diminished but not derailed. Does that tally with your view?
Well, it's interesting. It's always over a weekend. In terms of foreign policy from the US, this is probably the most sclerotic weekend we've had. So, of course, it had that sense of foreboding.
And I should point out that this survey was pre the ultimatum, but post the start of the war.
Yeah, so, it had a sense of foreboding over the weekend. And, of course, now we're coming back on a Monday with risk perceptions very high. Who has a crystal ball and can tell where this goes and where the timeline may end? But when we look at a number of barometers, which is what our equity strategy team's doing, Laurent Douillet in particular, we'll look at equity markets and we're getting back to support levels in the likes of the S&P 500 and the SXXP. The Nikkei seems to be heading that way. We've obviously seen bond spiking, bond yield spiking, the oil price spike. Five-year CDS has certainly moved as well, and it's getting a little bit more concerning. But I suppose when we look at this, in terms of fair value, and now all feeding into our fair value model, we're looking at a world where we were 16 times PE, say a couple of months ago prior to this conflict, and we're now looking at 14 times, which we think is about fair value.
So does that mean? But so things are cheaper in Europe. European stocks are a little cheaper, maybe around fair value. But are investors willing to step in right now with things looking, as to use your word, as sclerotic as they did over the weekend?
Oh, for sure. You think there's risk management been done and people will be looking at markets now in those key barometers, right? I mean, if we look at EPS growth, we were 11%. The market was discounting 11% EPS growth in Europe back end of last year. We were about 3 to 6%. So we do think there's some downside, but it's not quite Armageddon levels yet. And so, of course, next up will be the results season. It won't be so much about the results themselves, but the look forward to the companies. Higher oil prices, higher inflation, lower growth, that's all going to play into this. So the question will be, is 14 times about right, or do we have a little bit of a downgrade from the market coming? And one would assume the latter is probably true.
Yeah.
Skylar, let me bring you in here because we've seen some real outsized moves when it comes to precious metals. Gold's now down 5.7%, 4235 is where we trade. Silver down more than 5% as well at $64 an ounce. Bringing it back to equities, though, how much are the losses that we've seen on the Kospi in Asia tied to what we've seen in precious metals on silver?
I think it's all around this environment that we had prior to the conflict, where you had so much money rushing into very small markets. So the Kospi is one of them, gold is one of them, silver is one of them. And because that, it means you have an environment that has higher volatility. And so that means that there's more room for de-risking. More money can certainly come out of those markets. You know, we're only undoing the year-to-date gains in gold. We had many years of big gains before that. And it also means that you can't rely on your kind of historical relationship. So gold has been used as a safe haven previously, but because you've had a huge amount of money shift into that market, it means that you had structurally higher volatility in that market as you entered this year. And that's not something that you want in a safe haven. It needs to be a store of value. And so it just negates that property entirely. And then as we've seen year to date too, or at least on the conflict in Iran, it's not had a negative correlation with risk assets. So that's another kind of tick against it in the safe haven column.
Skylar, can I ask you about bond markets and where we maybe are nervous that stretched governments, where they exist, are going to be wanting to help out their populations with the higher energy costs, and where that's going to be difficult for bond markets to absorb. So we see bond yields going a little bit higher here in Europe once again. They certainly were a lot higher during Friday's session. I'm drawn to a couple of examples of this, and they're not all from Europe, but just this morning, Greece saying it's taking more measures to address the surge in energy prices. China, very different geography, different story, but of a similar theme, saying it may adopt fiscal and tax support if crude prices surge. This is going to be something that catches on. Where are you concerned that we don't have the ability to do this?
Yes, I mean, this is a big concern, because we're coming from a period where you already had deficits increase quite substantially because there was support provided to higher energy prices in 2022, 2023. So there are a couple places that are kind of fiscally vulnerable, like France, like the UK, and we've had yields rise at the end of last week, partly on this acceptance, I think, greater acceptance that energy prices will stay elevated, but also because of the monetary response, where monetary policymakers have said that they're more prone to react to supply shocks post-2022 than they maybe have previously. And so we've gotten the monetary policy reaction, but we're still waiting on the fiscal. Now, Starmer is meeting today to talk about whether or not there'll be more spending in the UK. And this is a very vulnerable market. Not only because post-2022 we had the Liz Truss crisis, so you get a more reaction from the market whenever there's something done poorly in the UK, but also because so much of the UK debt is inflation linked. So you get this really negative cycle when inflation rises, where it means that the Bank of England needs to hike because there is more of a response function within the UK to higher inflation. But you also have debt servicing costs rise automatically as a result of that, which means your fiscal position gets worse from the debt servicing side, but also growth being lower means you have fewer tax receipts. So the UK has seen underperformance, and I would expect that underperformance to continue.
So, Rod, let's say that fiscal support is not forthcoming, but the hikes from the Bank of England are. Where does that leave domestically focused UK stocks?
Well, I suppose in that position of people will be looking at defensive type plays, I guess, for the time being, and rightly so. I mean, the escalatory pathways to this conflict look pretty bleak and fraught with risk. So when we think about sectors that we're quite interested in, defense is obviously going to be one that people will probably keep exposure to. One could debate what's currently discounted in the valuation of some of these stocks, but regardless, you can see people will likely pull the defensive lever and stick with something like that. The other area that I'd mention, though, as well is pharmaceuticals. One of the things that we do in BI is an enormous amount of patent risk work. And we've looked at 4 of the world's biggest drugs from 4 of the world's biggest pharma companies. And the assumption that we're making is they're protected much longer than the market currently assumes, therefore higher revenue. So plays like that should be of interest.
Really interesting. Thank you for that. That's Rod Turnbull from Bloomberg Intelligence and Skylar Montgomery-Koning from Bloomberg Markets Live. Thank you both. Well, plenty more coming up on Bloomberg TV today.
Absolutely. We are going to be hearing from Fed Governor Stephen Miron, 12:30 London time, the sole dissenter at the last Fed decision. So not a surprise, perhaps, that he dissented, but interesting to bear that in mind as we hear from him. European equity markets then very much on the back foot this morning. We'll leave you with the team on the pulse. This is Bloomberg.